Welcome back to 5-Minute Farmdoc, where we take a brief look at various issues important to agriculture, to farmers, and to the industry, as well as the occasional discussion about farm policy. Today's discussion is going to be about crop insurance, and in particular, we're going to look at a recent proposal that's been discussed and has been written about on Farmdoc Daily by a couple of our colleagues from North Dakota that looks at changing the subsidy mechanism, the assistance the federal government pays to help cover the cost of a crop insurance policy. Specifically, the proposal was to cap the amount of the premium cost that the farmer pays, to cap that at 4% of the liability of the policy. And this would change the way we subsidize crop insurance. But to get to that proposal, we got to dive through a couple of details of the insurance program. There's one key thing to remember at the top and to sort of keep in focus as we make this discussion. The way we currently subsidize crop insurance does raise some concerns. Many policy debates, many farm bill debates raise issues about premium subsidy and the cost of the program. And of course, one of the issues that does come up when we subsidize insurance is how it may impact high-risk crops and the production of crops in high-risk areas. So one of the policy concerns we're always worried about is, are we providing too much of an incentive to produce in risky areas and risky crop production practices? So that's something we want to keep in mind as we walk through the concept from a policy perspective and what it means. But first, a few things on the crop insurance program that are important. There's a lot of details. It's a complex program. We're not going to get through all of it. But what we're going to focus on is the premium support mechanism in the current crop insurance program. It is the highest cost portion of crop insurance. And what this is each farmer that buys an insurance policy on their crop, this is rated, and that crop insurance policy has a cost to it. The federal government covers a portion of that, and that's what we call the premium subsidy. The way it's set up in the statute now is that each level of coverage, from 50% of coverage to 85% of coverage, has a different premium subsidy level or a premium subsidy percentage that's attached to it. For example, at the 50% level for a basic or optional unit insurance policy, the federal premium subsidy on that is 67% of the cost. So the federal government pays 67% and the farmer pays the other portion of that, which is what we call the farmer paid premium, which is the specific aspect that this proposal gets to. As we move up the scale or up the range of insurance policies, by the time we get to 85% on the basic and optional units, the federal government's paying only 38% of that premium cost, and the farmer is paying the rest. So that's how our current system works. As we move through it, what we wrote about in a Farmdoc Daily article is a lot more detail on this, but you can see in particular in Table 2 of that article some of the basic calculations around this. And so if you see, for example, we have a McLean County corn farm in there as one example, McLean County, Illinois, and at 85% coverage, the liability is over $1,000, $1,090. The total premium for that insurance policy is $64 an acre. And the premium support is $24 an acre. So the farmer's paying $39.71. So just a rough sense of how that calculation works. In that case, the total premium of $64, $24.34 covered by the federal subsidy, $39.71 coming out of the farmer's pocket. If we compare that to, say, Richland County, North Dakota, at 85% level, the liability is $904. The total cost the total premium cost of that insurance policy is $120.58, but it breaks out as $45.82 paid by the federal government in the premium subsidy and $74.76 by the farmer. So that's just a rough sense, and we got a variety of examples for different coverage levels, as well as a county from Texas, Sherman County, Texas, to give you 3 different regional comparisons of this. So let's now, understanding that what we're doing now is taking the cost and applying a percentage to it. One of the things we got to keep in mind is that the higher the cost of the insurance policy, the more the federal amount of subsidy, right? It's very simple math. 75% of $10, $7.50, 75% of $20 is $15. So we can understand that having a fixed percentage of different costs is going to have different payments under those circumstances. So even for the same level of coverage. So that brings us up to this proposal. In a recent article, like I said, colleagues in North Dakota talked about the idea of a 4% cap on the farmer paid premium portion of that. So what this would do would prevent the farmer from paying above 4% of the liability for that premium. Or that would be the basis on which that would be limited. So what it's doing is effectively capping the farmer paid side of that premium cost and pushing more of it into the federal subsidy side of the equations that we talked about earlier. And so in Table 3 in our Farmdoc Daily article, you can see the comparison again for McLean County, Illinois, Richland County, North Dakota, and Sherman County, Texas. All of them corn and at various levels of coverage. And so what it begins to show is how that's going to impact not only the cost of the program, but the way in which the premium subsidy impacts. In the counties where there's higher risk, what this ends up doing is increasing the subsidy for the farmer and lowering the cost of the insurance policy for that producer, which is arguably creating a higher subsidy in the higher risk counties. And this is one of the concerns that this potential policy idea really raises that needs to be looked into a lot further and further analyzed and frankly discussed and debated in any farm bill discussion, because this is a pretty important policy decision. Do we want to provide higher levels of premium subsidy support in the higher risk areas? In other words, we are putting more of the federal dollar in the riskier counties. We already do that under this system. Again, it's if you're paying 50% of a higher level, you are paying more of that premium subsidy. So if we go to this where we cap the upside of the farmer, that pushes more of it into the federal side. And so from a farm bill debate and from a policy debate, let alone the operation of the program, which as many of you probably remember, the crop insurance program is required to run at what we call actuarially sound. And actuarially sound is defined in the statute as that every dollar paid out in indemnity has to be matched by a dollar of total premium or a 1.0 loss ratio. And so that total premium, again, is the subsidy side and the farmer paid side. And so the issue is as we change that balance, what are the impacts on the ground? Are we encouraging more risky production, more risk, heavier risk areas? And are we increasing the cost of the program to do so? And how does that impact then the loss ratio and how the program operates across the country for all the crops and all the farmers that use it? So quite a few really big questions to sort out. Probably much bigger questions than a 5-minute farm doc can pull together. But this gives you an entry point to this and a whole lot to consider around this 4% premium cap proposal. It would increase the incentive to produce in higher risk areas, and we have to question whether that's the kind of policy we want to have in place, whether we want the policy to change in that direction. And part of that question is itself whether or not the taxpayers who fund these subsidies and support programs will continue to support that, or whether that will increase political pressure and otherwise cause challenges for that policy and the policymakers who are debating it in any potential farm bill in the coming year. So with that, appreciate your time and recommend you read the two articles and compare them for yourselves and think through some of the issues, and stay tuned as we will be working on this further, particularly should this idea be debated more in a farm bill debate.